The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Lovely to have you with us today. How's the volume? Can you all hear me? Would somebody please type into the question box that you can hear me? Are we there? Yes, no? Perfect. Good. Thank you. Delayed reaction. All is good. Thank you. Mike, you're with us, and Kevin and Peter. Good. All right. Thanks, guys. Yeah, we're a long way away from each other. These things take a few moments to drop across even on the wonderful internet, don't they? So good to have you here. All right. Today we're going to talk mainly about gold. So I hope our gold bugs are with us. Let me have a look. We've got Nick's with us, and Akshay, Albert, Chase. He's my give up smoking man, which you'll be glad to know, Chase, that I have. Jay, Jeff, be seeing you soon, Jeff. I got your email about your next session. Michael Peel, good to have you with us. The Murph up there, good to have you. Neil up at Cotton Farmer. Up north from here, Philip. I think you're Naz, aren't you, Philip? On the forum, if you are Naz, and I know you're a gold bug. I'm wondering if Sue's with us up in Cairns. Sue, hi, nice to have you with us, Grant. Okay, so today I want to talk to you a bit about gold, and particularly this phenomenon of its inverse correlation with the US dollar and what that's likely to portend going forward. So let's get ourselves moving along to start with. And nice to have you all here. It's a beautiful day down here at the Gold Coast, incidentally. It's in Queensland. It's just probably the first few days of autumn here. So we're starting to get a little bit cooler nights, but days are still warm, still fabulous. Ocean's very blue, so's the sky, and it's a grand place to be, I can assure you. Okay, so you're thinking about gold, you know, it's interesting that it creates such amazing passions in people. I can remember when I started the Daniel Code, or at least when I released it publicly, which actually is 11 years ago now. Time flies, doesn't it? I made a comment about gold being a very useful commodity for trading, and I got abused roundly by all the gold bugs for not appreciating all the wondrous hopes and dreams that they have. And time has gone by, and the market's gone up and the market's gone down, and it's been remarkably stable in the last few years, but I get it that gold has always been viewed as something of value, and sometimes conferring status. The Egyptians from about 3000 BC, they made lavish gold adornments for the kings and princes, and you'll be familiar, most of you, with Tutankhamun's tomb and the whole coffin covered in thick layers of gold. And of course, one of the interesting things is that archaeologists have not been able to find out where all that gold came from. They can't find a massive gold source anywhere near the Valley of the Kings and the tombs where much of the gold is. So, but traditionally, gold's been acknowledged as a treasure. But back in the early days, it wasn't used as coins. The Greeks also saw gold as a treasure and a status symbol, and that view of gold very much continues till today. The giving of gifts of gold is a worldwide tradition, but nowhere more than India, where it's a traditional bridal gift, which is why Comex Gold has a February contract, so all the jewelers can make sure they've got their gold supplies for the wedding season in India. But, think of the little things. Back in the day, I used to go to a lot of formal functions, and I had some gold cufflinks, and at one stage or another, I had some gold studs for my dress shirt. Old tradition, probably gone today, but back in the day when if you retired after a long innings, you got presented with a gold pen. It wasn't solid gold, of course, but it had some sort of veneer of gold. It was always seen as valuable, and of course it still is today. What brought gold into the modern epoch was the Bretton Woods Agreement, and that was in 1944. And after a couple of world wars and some enormous economic problems, including the Great Depression, and the basis of the Bretton Woods Agreement was that two things happened. The price of gold was fixed to the US dollar at the rate of $35 an ounce. And that went a long way to ensuring that the United States dollar became the global currency, the reserve currency as it's called, because all trading in gold was fixed in terms of US dollars. That went on more or less successfully, but there was always the problem that the price of gold, even though officially the official price of gold remained at $35, that's why you don't see any charts or many gold charts prior to 1971, 72, because there'd just be a straight line fixed at $35. I can remember those days, and I can remember when Nixon ended the Bretton Woods system, and gold became legal to hold by private individuals. So it dribbled along for a while at its $35 thing for many, many years with great difficulty. The underlying problem was the value placed on gold unofficially was many, many times the $35. So what the market was saying was basically, if gold is viewed as official currency, which of course it was under the Bretton Woods Agreement, it was a fixed value of US $35. But if gold had a fixed dollar value or an ascertainable dollar value, then it had to represent the value of, amongst other things, all of the debt in the world. And the gold market very soon came to the idea that the debt that these countries were having was many, many times the value of their gold reserves. So the price of gold kept pushing up unofficially, kept pushing up past the $35. And the government tried for many years to control it, and eventually they gave up. They couldn't. And in 1971, Nixon ended the Bretton Woods system. And from there, gold being free to trade, flatlined for a few years, and then dashed up to $800 was an much earlier spike. But the price of gold rose far beyond what any currency could sustain. And that's the whole basis, or that's a very important part of the basis of the gold bugs argument, which is that fiat currencies, or the currencies issued without the backing of gold, they're issued, all world currencies are now issued with the full faith and backing of their respective governments. So far from the days when there was either was or was supposed to be gold reserves equal to the issued currency at the face value of $35 an ounce, that all went. And you can see that lingering thought with gold bugs that if we can attack fiat currency enough, and let's face it, there are many, many reasons to attack fiat currency. As far as the logic of it goes, they're on the side of the angels there. But it's not going to happen because the whole world's economic system runs on the availability of fiat money, particularly to government, a part of which eventually, hopefully, trickles down. So you can see what gold's done. It wandered along. It had its big $800 spike. You can see that in 78, 79. Then it wandered along in the multi-hundreds for a while until eventually it took off. And we had this huge, wonderful big spike up and blow off top. And since then, it's actually held on. It's been very strong, in my opinion. So we have, what are these features of gold? I mean, first of all, scarcity. It's difficult to find and extract. And only about 2,000 tons of gold are mined each year. It's an excellent conductor, and it's highly malleable, and meaning it can be stretched and beaten into shape. 1 ounce of gold can stretch to a wire 50 miles long. And I never quite understood why you had gold-covered copper cables and what have you, but understanding that one ounce of gold can be stretched to a wire 50 miles long. It's quite aesthetic, quite effective. It certainly has and remains its aesthetic values. It's desirable as jewelry. Some of us have had, well, I guess all of us have had experience with that. Either for the gentleman's side, we've been givers of gold, and the ladies, Vicky's joined us now. Good to have you with us, Vicky. Are receivers of jewelry, beautiful stuff, gold. There really is no doubt about that. Just let me see if the chief, if the chief gold bug has arrived. No, not yet. He might be going to view this later. But Webby's with us. I didn't say hello to you, Webby. Good to have you. Jen Yu's now with us, as is John. A couple of Johns, actually. John down in Coffs Harbour as well. Big Mike, Big O, has joined us. Yes, so we're got a lot of our people here. So it's also seen as a form of storage of wealth, and you know, I have some difficulties with that. But there's lots of people are gold bugs. Some of my favourite people are gold bugs, and plenty of gold bugs are at the Daniel Code. Believe it or not, we do have a lot of them as gold bugs, and they're passionate about it. Some years ago, I went to Redding, California, to give a tutorial to a group over there, and they were all gold bugs. And you know, it's really interesting to talk to them. It's they're passionate that you know, gold is the only source of wealth and fiat currency is worthless. And they have conspiracy theories, and I mean, who doesn't love a good conspiracy story? I love them. I mean, anyone who ever saw Mike Moore's films after 9/11 and saw the horrendous footage of those buildings coming down with the explosions blowing out each floor as before they fell. You know, you have to at least admit that you've considered some of these conspiracy theories at the very least. But I love a good conspiracy theory. But the gold bugs are very highly invested in the fiat v gold standard, and the guts of that is if fiat currency were abolished and a gold standard was brought back in, then the price of gold would be, I don't know what it'd be probably tens of thousands of dollars an ounce now. I mean, that's the great dream, but it's just not going to happen, guys. But look, it's a fantasy. Keep hold of your dreams. They're precious to you. But gold bugs, of course, hate COMEX and all forms of paper gold. And I'm continually amused by the commentary in the gold push. And this gold push, the push to buy gold, there's always a drumbeat to buy gold on, even on fairly conservative, respectable publications. There's this background beat to buy physical gold. And it's really testament to what good promoters, the bullion banks and the and the marketers of physical gold and gold bullion, how effective they are as marketers. And that's why they have to run the argument that physical gold is the only real gold. COMEX gold, or paper gold as it's called. And there are other forms of paper gold apart from COMEX. There's all sorts of lease agreements entered into by bullion banks, etc. But the argument has to be, doesn't it, that none of that is real gold, because by pushing that argument, they promote the scarcity, the value of the scarcity value of gold. So you'll see these articles all the time that COMEX and some of the other methods of exchange of paper gold are a gigantic fraud. And some of these statements that we get are infantile. I mean, they're really quite childish. The common one you get is there were X thousand contracts in COMEX sold, which represents XYZ tons of gold. And look, they don't have it. There's not enough gold for delivery. Well, you know, they totally missed the basic point of an exchange market, that for every contract in COMEX and other exchanges, there's always two people in the transaction. If there's a seller on one side, there's a buyer on the other. If there's a buyer on one side, there's a seller of the other. So if you want to know how much physical gold is actually being handled in the COMEX marketplace, the answer's not much, if any at all. Just relatively small accounts, I guess, are handled on delivery. But the gold now, COMEX gold now, is cash settled anyway, so you can choose to have delivery. You can try to enforce delivery, but the exchange conditions are quite clear that unless there's agreement to do that, the contracts will be settled, cash settled. So that's the sort of interesting background that goes on. Most of it's led by a guy called Eric Sprott, who's a Canadian billionaire businessman. He's the king of the gold bulls. You'll have read a lot of his stuff. He runs businesses that include precious metal dealing, physical gold trusts, and physical bullion trusts. And his firms are very, very active in the promotion of gold. In fact, the first time I wrote an article about gold being great as a trading commodity, but limited value for other things, he was the first one kind enough to write me and tell me I was a complete moron, and didn't I know that they had proved conclusively that gold prices are manipulated by the banks, of all people. Quite why, I've never followed the logic for that, but they'll tell you. And he's very passionate. Of course, he's made a fortune out of selling physical gold. The whole point about physical gold is you can neither buy it or sell it anywhere near the real price, unless you're a dealer and connected with the big bullion banks. Just as an anecdote, some years ago now, I was talking to one of my students who was doing the Daniel Code tutorial earlier this week, and we were talking about some articles that I wrote for a website called Financial Sense. Very good website. And they had, I used to write regularly for them every week. You can read all those articles at the Daniel Code website. And they brought on an article by a gentleman called Dr. Antal Fakiti. I don't know if I'm pronouncing that correctly, but that's the way it appears to be spelled. Who's a very famous man. He's a world-leading mathematician, and he's got some interesting theories about money and gold. And he's a gold bug, and he attracts big crowds. He came to Australia. This is probably 15 years ago, or might be 10 years ago, something like that. And he had some town hall sort of presentations in Canberra, the nation's capital. But the point is that nobody except public servants actually live in Canberra. It's an artificial capital. Politicians spend the parliamentary sittings there, but that's all. But he came out with this statement, which he published in Financial Sense, saying that gold had gone in, COMEX gold had gone into a backwardation. And what that meant was that nobody would ever buy gold again. And I was staggered. Backwardation doesn't mean that at all for any of you that are new to trading. Backwardation simply means that the price of the far contract, the next contract or one further out, is less than the price of the current contract or less than the price of the front month, which is what we're always trading. The opposite of that, the normal situation for futures markets is that the far months are at a higher price than the near month because there's an element of time involved in holding the product into those extra months. And of course, interest costs, holding costs, are part of that equation. So the normal situation for futures is that the far month will be worth something more than the near month, and that's called a contango, C-O-N-T-A-N-G-O. It's a great word to remember at cocktail parties. That sweet little thing in the black dress can get quite excited when you tell her that you'd like to talk to her about contangos. But there we are. Ladies here are saying, look, he's a ledger. That's not true. Anyway, I hope you enjoyed that. But that was Antal Fakiti's take on it, and he was a world-renowned expert on gold. And I actually spoke to the people who owned Financial Sense and said, this is rubbish. When are you going to correct it? And they said, we're not, but one of the writers will. And a month went by, and none of the writers would touch it with a barge pole. So I said, well, I will. So I wrote an article saying, well, I've told you that this is rubbish. Whether the market's in a contango or backwardation says nothing about future trading. It may have some influences on price, but the idea that a market going into backwardation means there'll never be any selling again would shut down the futures market. It's absolutely ridiculous. Anyway, I read that article, and Mr. Sprott was the first to abuse me about it, along with a few others as well. But there are a few downsides to physical gold. The first is that bullion dealers and gold banks ensure you can't either buy or sell gold at its real price. If you believe that COMEX gold, with huge liquidity, fluctuating prices every moment, and less ability to manipulate prices than happens in the London market, where very few people actually are involved in settling the price, AM and PM fix they used to have. You look at COMEX, there's massive amounts of trading, massive volume. It's certainly a free market. And the very definition of price discovery is a willing buyer and a willing seller transacting in conditions of particularly good liquidity and ability to execute. That, in my view, is about as close as you can get at any moment in time to the real value of gold. So if you accept that, then I can save you the trouble of trying to do it, because I've tried myself. You can neither buy or sell gold, bullion, or coins or anything else anywhere near that price. Now, there's a good argument for that. The cost of producing the gold coins in particular adds to their price. But gold bullion theoretically should be available in quantity at whatever the real market price is, as set by an open and free market. And I can tell you it's not. So I guess there's always an argument about what is the real price of gold. Is it the London fix? Is it the COMEX price? Is it what the Perth Mint or someone else is offering at? So there's always discussion about that. But physical gold's very heavy, surprisingly heavy. We all sort of know it's heavy, but until you sort of pick up a kilo gold bar and see how small it is and how heavy it is, it's quite amazing. So physical gold needs storage. It needs transportation to that storage, and presumably from that storage at some time. all of this needs security, and not just physical security, but security against some of the things that have been happening in some of these bullion banks, that a lot of the gold bars, excuse me, or at least a substantial portion of the gold bars have changed around. They've been leased out or gone some other place and come back, and that some of these gold bars are not actually pure gold as they are supposed to be. No one's quite sure how that happens. It's pretty much hushed up, but it does happen. Excuse me. So, Chase, you'll be happy to know that even when you give up smoking, the vicissitudes of morning hay fever still prevail. So do excuse me. Gold futures. I mean, we love gold. I've traded gold for years and years in futures, but we not only love it because it's nice, it's pretty, it's a valued and treasured gift, but we value it because of its tradability as a commodity. And COMEX provides a futures market with high liquidity, great security, and the ability to trade few or as many contracts as you wish. And one COMEX gold contract covered 100 troy ounces of gold. And the exchange, of course, quotes it in US dollars and cents per troy ounce. But different currency prices for gold in different parts of the world are readily available. So COMEX is actually part of the CME Group, Chicago Mercantile Exchange. That's the biggest exchange in the world. And COMEX was joined NYMEX, which is the exchange it trades on in 2008. CME Group is actually 4 different exchanges that makes up CME Group. It's the biggest derivatives marketplace in the world. So, for those of the gold bugs who worry that they won't be able to settle their contracts, let me tell you, the day that the CME is unable to meet its commitments will be the day you don't have to worry about it, because the banks will have gone broke the day before. And so will everyone else. So you've got all the safeguards of CME Group, the biggest derivatives group in the world, and the margin for gold. It moves around a bit. It's been very stable, unlike the equities, which have been on a yo-yo ride, mainly up. But the margin for COMEX gold today is $3,700. So you can see this gold price. .org. They're very, very visible people. They're got a website with absolutely tons and tons of information on. It's all very interesting. This is one of their charts, and this is the 60-day gold chart with the up-to-date price of gold in US dollars. And you can see with the very next one, that's the gold price in Australian dollars. And because the Australian dollar now is somewhat weaker than the US dollar, as it should be, unlike those crazy years when it was worth $1.08 US, how that ever happened, I'm still scratching my head about that. But you can see that you can get a price at any currency you like pretty well. So this is this 24-day chart of gold versus the US dollar index. So you can take it that gold's the beneficial one that is loved and treasured, and seen as a store, as a status of treasure, as a store of wealth. And the US dollar index is really the devil. And you can see here dramatically 2 charts. The top chart is the COMEX gold chart. This is the 24-day chart. This goes back, excuse me, to 2001. And earlier on, just the way charts work, the earlier price movement in gold is so muted, it just looks like it's nothing much. But you can see at the peaks when gold had its major run up, you can see that the US dollar was very busy going down. So this inverse relationship comes and goes, and it seems to be almost the default. I would say better than 2/3 of the time, gold and US dollar are in this inverse relationship that a stronger US dollar is detrimental to gold, and a weaker US dollar is beneficial to gold. And that, really shows you how gold spends a lot of its time being affected by the US dollar price and also interest rates, very much so. This is gold on our 6-day timing chart. This is from the Fourth Seal link, which Frank DB helps us with every week. And you can see here that this is his current Fourth Seal analysis of it. He's looking just for more sideways action. He thinks it's a long-term bear market, which it certainly is, but shorter term, I think we've seen something more exciting recently. So that's where we are with that. It's got some 44, 59 time cycles coming up, and he was saying in the short-term version, if this market goes into that low, then the market will probably rally again. Okay, the DC signals will show you what's in play. Here we've moved, folks, to a 6-day chart. Let's see if I haven't missed anything. No, this is all good, everyone. Here, yep. This is a 6-day chart, and this highlights the pattern of gold being up, US dollar going down. It's not pari passu, it's not bar for bar. You can see that gold made its low many months before, I should say, the US dollar made its low back in April 2011, many months before gold made its final high. But you can see this general shape, gold up, dollar down, dollar up, gold down. Let's move on. And this is just another one of those charts. I think, what have I done here? Yeah, I've gone too far. There we are. So this is more of that 6-day chart, and this is bringing us up to what's happening now. And those of you who come to these webinars regularly will remember a few months ago I was talking about this correlation, or inverse correlation, was breaking down between the US dollar and gold. And as you can see, gold's had a pretty decent rally since about September, October, November even last year. This year at least, we've certainly had a very, very good, strong rally in gold. And you can see that the correlation is gone. The US dollar has not gone down as gold's gone up. So there's always the argument whether it's what they say, correlation is not causation, which is a fancy way of saying that these relationships can happen whether or not there's some real interdependency. But gold is the most fabulous trading instrument because it's so accurate. And this is the updated Daniel Code members charts of gold. These are published twice a week on the Daniel Code website. Have a look at the most recent high, and remember that Daniel Code target recognition is valid at a bar high low or on the close. If the market's rallying, as we saw it rallying up into, that's March the 25th, actually, that high bar on the blue line, we expect to get target recognition if the market's rallying at the bar high or at the close. Well, the close of that bar on March the 25th is 1329.0. Look at the blue line there, which was on the chart weeks, if not months, before it got there. 1329.1. 1/10 of a point, or if you like, in a number like 1329, and there are 10 ticks a point, that's 13,291 possible ticks in that number, and we have a variation of 1. And look what happened today. Here we are, the market had been down and had a little 1 bar up. What happened today? The low, 1284.9. Where's that Daniel code blue line? 1284.8. Same thing, 1/10 of a point, or 1 tick out of 12,848 possible ticks at that number. Incredibly accurate, and we see this with gold often. It's one of the most accurate markets. All markets are accurate because all markets are ruled by the Daniel code, but gold is particularly tidy and responds to the Daniel code numbers very, very well. Okay, you can see here that just shows you, I've put a highlight package on here just to show you that the correlation has broken down there. And you can see from about October, the US dollar index is having a weak rally. Gold's going with it at the end of the year, very much towards the end of the last week of December. US dollar index put in a key reversal bar down and started to go down, went down 4 bars. Remember, these are 6-day charts, so 4 bars is pretty well a Daniel code month. And from there it went sideways. Yet gold managed to just power through that, keep going up, and gave us some really good trading on the long side there. So the question is, what happens when correlations break down? And we've seen this. You can go back as long as you can find gold charts, which is 1975, and US dollar index charts. We've seen this this inverse correlation happen continuously for very long periods of time. Usually about 2/3 of the market's time is spent in these inverse correlations. So what happens when these inverse correlations break down? Well, what happens, in fact, is that they're positive for gold. Excuse me. When the inverse correlation situation has broken down, it's positive for gold, it's strong for gold. And if you look what's going to happen going forward, you start thinking about a US dollar index. The biggest mover of the US dollar index is the interest rate. And this, when the USD is up, we expect gold to be down and vice versa. But interest rates are the primary mover of the US dollar index, or the US dollar per se. And Trump is a property guy, and property guys all hate high interest rates. I mean, anyone who has to borrow money hates high interest rates, but property guys in particular. And Trump has already shown he's capable of pressuring the Fed and the Treasury to lean the way he wants. Now, I know the Fed will immediately deny that, but the evidence is that he's been very successful in getting the Fed to more than moderate, actually reverse course and back off their proposed tightening of interest rates. And of course, Mnuchin, as the treasurer, he works for Trump. I won't say that Trump controls him. He's a very wealthy man in his own right, very successful at Goldman Sachs, very, very successful as a film producer before he became treasurer. Some of the really big, good-name films you'll see, he's been the producer of them. But he's a smart guy, and he certainly knows what side his bread's buttered on, and Trump is actually moving heaven and earth to avoid interest rates, because in the same way that gold has an inverse relationship with US dollar index, which is the main driver of which is interest rates, of course, the stock market's the same. The stock market is very, very addicted to cheap money, massive amounts of it, huge liquidity, and very low cost of borrowing funds. And you saw yourself the temper tantrum the market had when the Fed started, US Fed started trying to take steps towards, as they said, normalizing the interest rates. And this is, of course, all tied up with debt. And the whole world has gone on a debt spree with lower interest rates. Governments, institutions, big corporations, all at the same time have said the same thing. Money's really cheap, let's spend it. And you've had the situation that now the Western world truly has the most horrendous debt that you could imagine. I looked up the figures and I decided not to put them in because they're meaningless. They are so big, they are beyond the comprehension of normal people. They may mean something to economists, certainly when they're compared to previous numbers. They're very, very interesting. But this is happening all over the world. I mean, the US, Obama, was the most profligate spender. The US foreign debt levels went through the roof under Obama, and Trump's just added to it. The tax cuts are being paid for essentially in debt, and the US debt is bigger than ever. Probably doesn't matter so much for the US, but it's happening, all over the world. And in fact, we've got in Australia a federal election coming up in a couple of months. It was announced last week, and Parliament's brought down its new budget. And I mean, honestly, it's a complete furphy. The idea of restoring the budget to balance and all the goodies that it offers. So they're 10 years and more away. That's not just outside the power of the existing government, which is almost certainly going to fail at the next election. It's another 2 elections after that. And what they've done, and what all governments do, is what's called the forward estimates. They have long periods of time. Government has to plan for its funding, just like corporations and individuals do. And the forward estimates are included in the budget. So if they think they're going to have some more money coming in 6 or 7 or 8 years from now, they'll include that in the budget. And they'll say they're going to give you huge tax reductions. But look, it may happen or it may not happen because the vast majority of the money, at least of the Australian government, it's called a liberal government. It's not liberal. It's for you Americans will understand. Excuse me. Liberal is a bad word, and it's called the Liberal government. The Liberal Party, founded by Sir Robert Menzies many years ago, but in fact its whole characteristic is that it's a conservative party. It's sort of the equivalent, if you like, of the Republicans in America, and it's in fact been torn apart by its own internal forces, with essentially a battle between real conservatives who are in the Liberal Party. Let me tell you, there's precious few of those, and liberals, real liberals, who are, in favour of all those things that liberals are in favour of. So we've had the companies being the Liberal Party of Australia, of which I've been a member for 60 years nearly, maybe 55 at least, has been totally destroyed as a conservative party by the influx of liberals, particularly parliamentarians like Julie Bishop and others, who have masqueraded as conservatives, total and complete frauds, but they're never found out with any consequences until the government gets thrown out, by which time they've feathered their own pockets pretty well and are off to be on speaking circuits, tours, sitting on boards of various organisations. Usually the United Nations will find them a nice spot if they're liberal enough, which plenty of our so-called conservative politicians are. Don't let me get started on that. That'll go on and on and on. But debt at low interest levels are the norm right now. And Donald Trump, in my view, is there for a long time. He's got another 2 years to run on his existing term. And there is no prospect in sight. This may all change. But looking at the potential challengers, or in fact any challenger from the Democratic Party in America, the odds must overwhelmingly favour Trump getting re-elected. And the president has some very unique powers over Treasury. And Trump is a man who can wield a great deal of influence. His own people find it very hard to say no to him. In fact, I'm sure a lot of people find it hard to say no to him, which is why he's, I guess, been such a successful businessman. He has things done the way he likes it, otherwise you're out. And that obviously has worked pretty well for him. Not sure the trade unions in Australia would allow that, but nevertheless. So what actually does happen when, if interest rates rise? Well, the reality is they're probably not going to, because who can afford for interest rates to rise? US economy can't. US stock market can't. Trump has wholly invested his credibility and his tenure in the US stock market. If it was to crash, it'd be his ratings to go down with it. He understands that interest rates being kept low is a huge driver of the amazing, wonderful success that the American economy is having. So that's that. So let's move on a bit as we're getting time's running on. And I want to just show you a bit about our 6S success trading. This happens to be gold, and I've been telling you what a great trading model it is. Well, this little bit of chart starts about 6 weeks ago. It starts about the 12th or 14th of February. And you can see some really decent runs in there. You can see 2,200 up, almost $5,000 in one run straight down, 790 up, 1,500 the last little bit of a run down. And you can see some of the losing trades in there. That's a pretty normal pattern of trading. With the trading we do, we don't have a huge winning percentage, but what we do is the average win is, as you can see, is very, very much bigger than the average loss. There's a couple of other losers in there. I didn't put them in because they're a bit complicated to just fit into a chart. But basically, what I want you to do is notice some of those bigger bars in there. Let's just have a look if we are found here. Look at the size of this bar here. Now that bar is worth about $2,500, one bar. Earlier, some of these, this big down bar and this grey outside bar, they were worth about, close enough, a couple of $1,000 each. I want to just try and get you to think about the sequencing of your trading. That if your trading is using a mechanical system, which success is, then there's no bias to the selection of trades. They're all based on exactly the same criteria. But one of the things that varies is the potential value and potential risk of those trades. So have a look, if you would, please, those of you who are interested in success trading. And if you're not interested in success trading, you should be, because it's been fantastic. I'll have the first quarter's figures for you over the weekend. We'll put them up at the website. I'd hoped to have them for you today, but my tech guys down in Melbourne were busy running some other programs yesterday. I couldn't get them. Have a look at the size of these daily bars. So these are figures I've taken out. They're 225 days, 225 trading days. A full year is 255 trading days, so it wasn't intended to be a full year. It was just intended to be a long sample. So 225 days, so it's 7 or 8 months of a year. Look at what the daily bars are worth. So oil, the average daily bar is 1,800, US dollar index 500, mini S&P, E-mini $1,800 a bar. Heating oil is a biggie. And have a look where we've put in gold. The average daily bar in gold is 1,190. Now, what we're doing with the 6S is we're creating directional signals to buy and sell or hold every day. And if our assumption is we're with the trend, then we're using a 1 bar stop. If you're long, your 1 bar stop will be the true low of the last one completed bar. If you were using a 2 bar stop, it'd be between below the lowest low or above the highest high of the last 2 completed bars. But have a look at gold. Here's gold. Over 225 days, the average daily bar is $1,190. And when we think we're against the trend, we use what we call a discretionary trailing stop. And at the moment for the 6S program, we're using 44% of the average daily range. Now, those of you who are actually the Daniel Code tutorial, you know what I'm talking about, and you're using a slightly different number. Stick to the number that I've taught you. This is a different system. This is a mechanical system. And it's different to your own trading, and I should say, not as good as your own trading. Nothing will ever be as good, in my view, as the educated Mark I human eyeball. So, here's the point. If the average daily bar of COMEX gold is $1,100 or say $1,200, and all our trades day after day after day after day, we're using a 1 bar stop on entry and for our next entry, then we should be wagering about $1,200 on every bar. So what happens when we get these bars that are like $2,000, $2,500? Well, if we get a loss on that bar, we're in fact losing not just one of our winning trades, but 2 of our winning trades. So by having your trading exposed to bars that are substantially, I mean, don't get too anal about this and start worrying about it. It has to be a substantial difference to mean anything. Don't go starting to measure every bar every day. It'll drive you nuts. But where you've got a substantial difference in the size of the bar for where your stop's going to be, which is effectively your risk management, or where your entry will be, which is also part of your risk management, use the average daily bar instead of using your 1 bar stop. Or if you want to extend it a bit, go to 1 1/3, go to 1,300, 1,400, 1 1/2. You can go to 1,500, but avoid having your risk out at $2,000 on gold or more, because what it'll mean if that trade fails, you'll have lost 2 of your winning trades instead of just 1. So bear that in mind, folks. Have a serious look at these numbers. If you haven't written them down, this is being videoed. It'll be back on the website probably tomorrow. But try to keep all of your trades somewhere around the average daily bar, 1 1/4, 1 1/3, maybe 1 1/2, not much more. Okay. Remember also with our discretionary stop, when we think we're against the trend, we're using 6S, we're using 44% for the 6S program. You don't have to use 44. You can use any amount you like. It's your money, do what you like. It's a basic trade-off. It's the smaller the amount you make that discretionary trailing stop, the more often you're going to get stopped out. And you should, if you're going to use a different discretionary trailing stop when we assume we're against the trend, you should make it a Daniel Code percentage of the average daily range. So next one down is 37.5%, then 29%. And the next one down from that's 14.8%. You can use much smaller stops, and you'll get stopped out more often. but the whole point of this program is we're quite generous with the stops when we believe we're with the trend, and we're aggressive with the stops when we think we're against the trend. So that's about it for today, folks. If you're seriously interested in trading and you have a plan or a desire to become a super trader, do let me know. I've trained a lot of people to trade. They are amongst the best traders in the world. Some of them are with us today. Sue, good to have you. And Murph and quite a few others. Big O, quite a few others. Very, very good traders. If you want to join them and be a super trader, send me an email, jneedham@thedanielcode.com, preferably with your phone number and country and location, so I don't call to wake you up in the middle of the night, which will make your wife, friend, or sleeping partner very unimpressed. And I'll be happy to give you a call. We can talk about your trading, and if you're really serious about becoming a super trader, I can get you there, and we'll be delighted to help you. Okay, if you haven't already had a free trial of the Daniel Code, you're most welcome. There's a tag saying free trial at the Daniel Code website, www.thedanielcode.com. Just click on that. That'll take you through it. If you have any problems at all, contact Terry at support@thedanielcode.com, and he'll be happy to assist you. In conjunction with that, we're a partner. What's the likely path? I'll come to you, Akshay. We're a partner with Genesis Trade Navigator. You've seen their software, which I use exclusively. If you would like to, we can arrange a free trial with them also. Okay, so this is our compliance statement, folks. The main point is understand very clearly trading is risky. If you don't know what you're doing, you'll lose all your money, and I promise you, you'll lose it very quickly. The industry says you'll lose, I think it says 90% of people lose 90% of their money in the first 3 months. My experience is that new traders lose all their money and keep on losing it. Learn to trade, for goodness sakes. Don't risk $1 of money until you know what you're doing. And if you want to learn to trade, let me know. I'll be more than happy to teach you. Okay, let's see. Akshay, you want to know what's happening with gold? Well, I think it's going up, mate, because I think Trump is absolutely determined to keep... Oh, you want something else now. Okay. Trump is absolutely determined to keep U.S. interest rates down, which is very, very good for gold. You want to talk about Euro USD. Let's have a look. Here we are. CD. Here, Euro USD. Here it is. See if we had anything on it today. Euro USD, we've got an inside bar sell for today. Actually, if you didn't pick it up, there's a sell signal for today. This is a very good trading market, isn't it? You see this sort of pattern of, up and down and up and down. That's perfect for futures traders and for spot forex trades. Absolutely wonderful. Okay, well, thank you for being with us today, folks. It's the famous time of the week now that it's 11:30 on Friday morning. I put my orders on for tonight, so I'm finished for the week. And it's time for a couple of Bloody Marys, and I wish you could all be with me. That would be great fun. Anyway, glad to have you with us. Good on you, Mike. And Adrian, all of you, John, to you too, buddy. Okay, all the best, folks, and look forward to talking to you. Anytime you need me to advise you on anything or you want to talk to me, just shoot me an email, jneedham@thedanielcode.com, and I'm always here to help you. Bye for now. Bye-bye.